In this video, we're going to talk about Sofi Technologies, trading under the ticker symbol SOFI. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. Those are prepared, recorded on the day before and scheduled for the next day. If there are significant and volatile movements during the trading day, they will not be reflected in the video itself. With that being said, to the extent possible, my analysis will be based on the medium term or even the long term and not necessarily on the intraday movements. The main reason why it shouldn't matter that much is because most people investing in stocks or even just trading in and out of their positions usually keep their positions open for at least a few weeks. With that being said, if there are significant movements in the stock price that happens afterwards, either they will not affect the overall picture, so in that case we will cover them the next time we're supposed to cover them, or if they are significant enough that they change the outlooks, then yes, I will do a follow-up video in the shortest delay possible with a reevaluation of what I think should happen next. Sofi Technologies operates in the financial services sector. It provides the services of loan, refinancing, credit cards, as well as wealth management solutions. It's a company based online and separates itself from competition mainly from the fact that it's more virtual than physical. So its appeal is the massive user base subscribed to its platforms, consisting of a large pool of potential clients, paying clients, and contributing to the fast growth of its revenue amount and in the number of revenue streams. Sofi benefits from famous investors who are almost perceived as superstars in this day and age, and the fact that after years of discussion and speculations, it seems that now is a mature phase to develop and deploy those types of virtual banks to consumers at large. The market cap of Sofi is currently at $17.6 billion, and the enterprise value is at $9.1 billion. In other words, there's a significant markup or premium over how much Sofi is worth. The market cap is the price tag of financial market that it's willing to pay for a company right now for its future, and also like the short-term fundamentals. The enterprise value of the company is the accounting net result of how much the company's assets are worth once the debts are paid back. Usually the market cap is higher than EV because the EV is mostly now, but the market cap is also future focused. So it's also the case for Sofi because it's almost double what the company is worth in tangible assets. The quick ratio of Sofi Technologies is 0, and the current ratio is 0.15. The debt over equity is 0.57. This means that compared to many startups, Sofi is relatively more leveraged. So if this is something that worries you, like the leverage, then you should definitely adjust how much you want to own, or if you want to own Sofi shares. For me, as a company in like the finance sector, I don't think that it's that much of an issue, to be honest. And I don't think that this kind of statistics will be reason for the company to dilute massively its shareholders in the years to come. The average trading volume of Sofi has been 24 million shares a day, and the daily trading volumes recently have been hovering around 17 million shares to 24.4 million shares. The 1-year beta of Sofi Technologies is 0.55, meaning compared to the rest of the market, it's not as volatile, right? But nevertheless, I think that in terms of its future opportunities, it has enough steam to go upward and to bring you a lot of profits. Its 52-week high has been so far around $28.26, and the 52-week low is $10.10. Now, let's take a look at the options market for SoFi. In terms of volume and open interest, they seem to favor the call option side. So generally speaking, the put options would suggest that the market expects a pullback because it gives you the right to sell at a certain price, and the calls give you the right to buy the stock at a certain price. The key strike prices where there seems to be the most interest are $22.50, $23, and $25. Overall, SoFi is currently on the track of becoming the bank of a new generation. With infrastructures that are virtualized, the fixed costs that are far lower than the conventional banks, and the revenue streams that are very diversified in multiple areas. The question we should ask ourselves is whether this kind of momentum is just a temporary blip, or if this is part of an ongoing trend of an industry to become more virtual and leaner. If that's the case, then SoFi would have a brilliant future ahead of it, regardless of the short-term price fluctuations. In some ways, virtual banks already exist across the world, because many banks, which you may be using, allow you to conduct most of the businesses in the virtual environment. So in terms of how clients would feel when banking with SoFi, I think that the adaptation would be done quite smoothly. My recommendation is to allocate 5 to 10% of your portfolio for SoFi shares and buy 50% of the allocation now, so that you keep a foot in the door while also having a certain amount of capital to scoop the bottom later if the opportunity becomes available. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks, things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.